probably noticed that practically everything tied to artificial intelligence is going parabolic right now. Well, today, we're looking at Sterlite Technologies, or STL. This is a company currently riding the wave of a massive, jaw-dropping 300% stock rally. And this incredible surge, it's being driven almost entirely by the explosive demand for AI data center infrastructure. But whenever a stock skyrockets that fast, we have to pause and ask a tough question. Is this genuinely sustainable growth, or is the market just getting totally ahead of itself with FOMO? Today, we are going to peel back the layers and break down the actual financial reality behind all this hype. But first, a quick note. Welcome to Stress-Free Investing Analysis, Personal Notes. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. All right, let's dive into the game plan for this explainer. First, we'll look at their pivot into AI infrastructure. Then we'll check out their financial turnaround in progress, followed by some massive red flags you absolutely need to know about. After that, we'll map out the bull versus bear scenarios, and finally, we'll land on our final investment verdict. Okay, part 1, the AI infrastructure pivot. Let's figure out exactly why STLTCH surged 300%. It really all comes down to this massive catalyst. We're talking about a 1.1 billion, yes, billion with a B, multi-year product award letter. And this isn't just a run-of-the-mill order. It's from an unnamed US Hyperscaler, specifically to supply AI data center infrastructure over the next few years. That right there is an absolute game changer. What's happening is STL is successfully shifting from just being a standard commodity optical fiber manufacturer into a vertically integrated, AI-ready glass-to-data center provider. Now, you might be wondering, why does AI matter so much for fiber? Well, AI data centers actually require 10 times more optical fiber per rack compared to traditional cloud setups. Every single GPU cluster at these massive tech companies needs huge fiber interconnects to function. Thanks to this massive structural demand, STL is sitting on a record open order book of 7,309 crore rupees. That's up 67% year over year. When you combine that with the hyperscaler deal and their other broadband programs, they are looking at historically unprecedented revenue visibility of around 16,500 crore rupees over the next 3 years. Moving right along to part 2, financial turnaround in progress. Let's see how they're cleaning up the balance sheet. Over the last 2 years, STL didn't just sit around. They executed a major strategic pivot. They realized their global services business was a massive drag on margins and tied up way too much working capital, so they demerged it. Then, to survive the industry downturn and fix their financials, they raised 1,000 crore rupees via a qualified institutional placement. They basically brought in institutional heavyweights to inject much-needed cash. Those tough foundational decisions allowed them to radically reduce debt and finally start improving their core margins. And the numbers really tell the story here. Back in their FY23 peak, their net debt to equity was sitting at a highly stressed 1.74 times. Fast forward to the first half of FY26, and they've slashed that down to a very comfortable 0.55 times. That debt reduction gives the company essential breathing room and fundamentally changes their overall risk profile. So the math checks out in their profit and loss statement too. For FY26, revenue grew nearly 19% to 4,745 crores. Their operating margins, or EBITDA, have actually improved sequentially for 6 consecutive quarters, landing at 13.2%. And perhaps the best news? After a really tough few years, profit after tax has finally turned positive at 56 crores. The turnaround isn't just a story, it's mathematically real. But here's where we need a reality check. Part 3, massive red flags ahead. I like to call this the price of perfection. This right here is the ultimate tug of war for the stock today. On the one hand, you have that incredible 7,309 crore order book we talked about. But on the other hand, there is a devastating $96.5 million trade secret verdict against them from a competitor, Prysmian. That translates to roughly 810 crore rupees. Now, STL is actively appealing this, so it currently sits as a contingent liability. But make no mistake, it is a massive, dark cloud hanging right over the stock. To put those numbers into perspective, STL is currently operating at just a 1.2% net margin and a really weak 8% return on capital employed. They are barely scraping by with profitability right now.
So if you look at that potential 810 crore legal hit, that single payout is roughly 14 times their entire FY26 profit. They literally have zero margin for error. Any cost shock, any tariff reversal in the US, or a loss in that lawsuit, and their earnings get completely wiped out, effectively erasing all that balance sheet progress they just fought so hard for.
And that leads us straight to their valuation. Because of this recent 300% rally, the stock is trading at 298 rupees. At a staggering 260 times trailing earnings, it is priced for absolute perfection. Think about that for a second. Investors entering right now are paying top dollar for a flawless future that hasn't actually materialized in the bottom line yet. The market is just assuming they'll rapidly expand net margins to over 5% and perfectly execute that billion-dollar order. Oh, and by the way, they just announced a proposed 2,000 crore fundraise, which means more serial equity dilution is coming for existing shareholders. So, how do we weigh all of this? Part 4, Bull versus Bear Scenarios, where we value the future. In our analysis, we've had to assign a pretty hefty 30% probability to the bear case. Why so high? Simply because of that Prysmian lawsuit and the extreme valuation risks if their execution stumbles even a little bit. We give a 50% probability to the base case, assuming they stay on track, and just a 20% probability to the perfect bull case scenario where they win the appeal and maximize all their margins. When you run the numbers on those scenarios, the bear case brings the stock crashing down nearly 40% to 180 rupees. The base case gives a moderate 20.8% upside to 360. But when we calculate the probability-weighted target blending all of this together, it lands at 328 rupees. That represents only a minimal 10% upside from the current market price. Honestly, the risk-to-reward ratio right here, right now, is heavily skewed against new buyers. Let's wrap this all up in Part 5, the final investment verdict, and our stress-free strategy. With retail investors' shareholding surging and intense FOMO driving the market right now, we have to ask, is it actually safe to hit buy on Sterlite Technologies at its current valuation of 298? The objective verdict based on the hard data is accumulate, but with extreme caution. It scores a 48 out of 100 with us, which earns a D+ grade. You absolutely should not initiate a full position at the current market price of 298. The smart move here is to avoid chasing the hype. Only accumulate in small tranches if the price corrects back down to the 240 to 260 rupee range, where you actually get a decent margin of safety. If you do decide to buy, treat it as a 3 to 5 year horizon play, and size it strictly as a satellite holding, maximum 3 to 5% of your portfolio, because those looming legal and execution risks are very real. Before we wrap up, a quick but important disclaimer. The analysis shared in this explainer is for educational and informational purposes only. I am not a CB-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a CB-registered professional before making any financial decisions. If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below, and it might be the subject of my next explainer. Thank you for watching, and keep your investing stress-free investing. I'll leave you with this one final thought to ponder. Is this AI infrastructure boom an unstoppable rising tide that will inevitably lift all boats? Or are buyers of STL today paying for a perfectly flawless future that is statistically unlikely to ever arrive?